Hi, everyone. I see a couple of comments saying that you can't hear, and the reason is that we're waiting a couple of more minutes. We're going to start in maybe 1 minute. I see a lot of people joining. Just one more minute, and then we'll start. Thank you. Hi, everyone. My name is Michele Ferrario. I'm the co-founder and CEO of Stashaway. Thank you so much for joining tonight and for being on time. I'll be the host tonight. I'm trying to show you the presentation. So I'll be the host tonight, and tonight we're going to talk about investing the right way with ETFs. If you have a few minutes now, maybe I'll wait a couple of minutes. If you can, just type tiny.cc/SA20 or simply scan the QR code. And if you just can spend a couple of minutes answering the survey, would be fantastic. And after you guys have done it in a couple of minutes, we'll start for the presentation. As you do the survey, maybe what I'll ask you as well is, through the course of the presentation, feel free to ask questions through the Q&A function. Don't use the chat, please, but use the Q&A function. At the end, I'll go through Q&A. I will try to do as many as possible. I can't promise to do them all because I see there is a lot of people in the presentation today, and so I am not sure I'll be able to cover everything. I'll go in chronological order from the earlier questions to the other one. So maybe I ask you already to forgive me in case I don't get to the final ones. In case you have any question that I cannot get to, feel free to send an email to support@stashaway.sg or contact them through our WhatsApp number. You can find a WhatsApp link on our app, and our client engagement team will be very happy to answer any of your questions. There's actually quite a few colleagues of mine also in the seminar tonight, and they will be trying to respond to some of your questions during the presentation. So to leave some of them to me for the end, but I will try to address whatever they can throughout the evening. So thank you already, Amanda, Asher, Seeing, and Nathan, for helping me tonight. As you can see, we are expanding the number of people that help answering questions just because of the incredible turnout we're having for these events. Okay, I think we can start. As mentioned earlier, tonight we're going to talk about how to invest the right way with ETFs. And I'm going to talk a little bit about what ETFs are and how you can think about using them for your investments. I'm not going to spend too much time on Stashaway. I will assume that most of you will know what we do. We are a digital wealth management platform. We help people like all of us invest their money through a very simple platform, very low cost, that gives access to very intelligent investing. Again, I'm not going to spend too much time on this. I really want to dive into what ETFs are. Tonight's presentation is about ETFs, as I mentioned, and it's one of our Stashaway Academy courses. This is what we consider an intermediate course. If throughout the presentation you feel you don't understand what I'm talking about, because you might miss some of the, you don't know what equity means, you don't know what a bond is, or you don't know what asset allocation means, then maybe you should consider doing the financial planning basics and investment basics course as well, and perhaps kind of redo the how to invest the right way with ETFs later on. I'm not going to go through all our courses. You can see them live on the screen right now. Maybe one thing I'd like to talk about is that in the last few weeks, we have actually launched Academy in app. What is that? If you have the Stashaway mobile app, either Android or iOS, you'll see that you have a tab called Academy. That's been there for quite some time. What is new, though, is that in that tab, not only you can book to participate to webinars like tonight, and hopefully soon to seminars when once hopefully COVID-19 goes away, but also you can now watch on-demand videos of our most important courses. So on the screen, you see the investment basics one, the financial basics one. You see that it's actually every course is divided into a few modules. Every module is somewhere between 5 and 10 minutes. We put a lot of care in making it easy to understand. There is subtitles, so if you don't understand my accent, you'll still try, hopefully, be able to understand what I'm trying to say. There is charts, so it's quite comprehensive. We are, over time, will increase the number of kind of courses available there. If you have any feedback after you watch any of them, feel free, actually, please send us an email at the contacts that Amanda just shared on the chat a few minutes ago. So let's dive in. We're talking about ETFs tonight, but let me make a step back first. So as you invest, you can divide the process of investment in two pieces. You first need to do what is called asset allocation, and then you need to do security selection. What does it mean? Let's say you have $100,000. The first question you need to answer yourself is, how much of these $100,000 I want to invest in North American equities? How much I want to invest in Singaporean equities? How much I want to invest in government bonds? How much in US government bonds, Singapore government bonds, Japanese government bonds? How much in corporate bonds? How much in gold? How much in real estate? Okay, that's asset allocation. Let's say that you decide that you want to invest 20% of your $100,000 in US large cap equities, so in large companies traded in the United States. The next step is to do security selection. So to decide of these $20,000 that you've allocated to securities, so to North American equities, to decide whether to buy Google shares, Amazon shares, General Motors shares, Zoom shares, or whatever that might be. Okay, so the second piece is security selection. Now, everybody always talks about security selection. Why? Because it's sexier. It's very good to say, look, I bought DBS share when they were at $10 a share. Now they are $30 a share. Or I thought that this company was doing well, and in fact they did well. But the reality is that 80% of the difference in returns among different portfolios actually come from asset allocation. And this is not me or Stashaway saying this. This is every large asset manager in the world. BlackRock actually says 97%. Vanguard says somewhere between 80 and 90%. So I'm being conservative and saying 80%. If you want to see what BlackRock says about this, there is Larry Fink, who's the chairman of BlackRock. BlackRock is the largest asset manager in the world. They manage $6 trillion. And there is the latest. So I see that Inchan says that he or she cannot hear me. Amanda, please let me know if it's my problem or it's potentially.
No, I can hear you. I think perhaps you might want to check. So maybe you want to check your volume because we can hear Michele actually.
Perfect. Thank you. Thank you, Amanda. And yeah. So what I was saying is, if you want to kind of get a different perspective on this and you want to read some of these topics, you can find online the latest letter to BlackRock shareholders from Larry Fink, who's the chairman of BlackRock, the largest asset manager in the world, and he speaks a little bit about asset allocation, and he actually says that so there is a few people with problems. I'm going to go on unless you guys, unless Amanda stops. So you stop me if something is wrong. Otherwise, I'll assume it's a few people. Unfortunately, we have a lot of people tonight. So I know what I can do. Give me 1 second. Sorry, give me just 1 second. No, it's already the best I can do. Okay. Okay, I'm gonna go ahead. Sorry, guys. So just check out for the Larry Fink letter to shareholder if you want to read kind of a third-party point of view. That's BlackRock, the largest asset manager in the world, talking about why asset allocation is so important. So why I'm not going to talk about security selection is for two reasons. One is what I just mentioned, which is that most of the difference in portfolio return actually come from asset allocation. So I want to focus on what is most important, asset allocation. But then there is a second reason. So let me ask you the question. Should you pick stock? So there is one function you can use on Zoom, which is raising your hand. Can you raise your hand if you believe that you should, as part of your investment activities, pick stocks? So decide whether to invest in DBS, OCBC, UOB, Apple, General Motors, Amazon, etc. Okay, I saw a few hands. Okay, it's around 20% of you guys say that you want to pick stock. Let me try to convince you otherwise. So how easy it is for a non-professional investor to beat the S&P 500 or the STI or any other index per se? Well, if you look at the numbers, it looks like it's quite difficult. In the last 15 years, so I'm not talking about 6 months, 3 months, 9 months. I'm not talking about luck. I'm talking about long-term performance, 15 years. 92.3% of professional fund managers, people whose job is to pick stocks in order to beat the benchmark, to beat the index, for US large cap funds have underperformed the market. So have done less than the index. And the index in this case is the S&P 500. Okay, you could argue, which in practice means that only 1 in 20, more or less, professional fund manager has done better than the index at picking stocks. So you could argue, look, it's just because it's US large cap fund. So let's look at smaller cap funds. So if you look at mid cap, that's 94.8%. If you look at small cap, that's 95.6%. This is not my numbers. This is SPIVA, S-P-I-V-A, so the S&P 500 data. You can find them online. So in the last 15 years, no US professional fund managers at any size of kind of equity investments, small cap, mid cap, or large cap, have systematically outperformed the relevant benchmark. You could argue it's a US problem. Maybe in other geographies works better. And to be fair, in other geographies works a bit better. But still, even in India, which is kind of the place where security selection seems to be working the best, only 1 in 2 fund managers actually pay for themselves for security selection. And these are professional fund managers. Remember, they're not like people who have other types of jobs. So why is it so difficult to beat the market? And the reason is that 30 years ago, the job of a fund manager was included, going for a coffee with the CFO of a company and hear some whispers about something that was going to happen. And the CFO will say, look, we've just done this investment. We haven't announced it yet. And so that the fund manager could go back to the office and trade on that asymmetry of information. Now, you can't do that anymore because people go to jail for that. And that's why the more transparent the market, so the US, for instance, the more difficult it is for active managers to beat the index. The more intransparent the market, the more asymmetry of information is there, the more it's still possible for some asset managers to beat the market. That's why in emerging markets, you still see a better performance of active asset managers than you see in developed markets. The second thing that happened over the last 30 years, on top of regulation becoming more difficult, is that the internet came along. And therefore, 30 years ago, as a fund manager, you would receive the financial statements or the quarterly earnings of a company in paper, right? In a big stack of paper. And if you were a larger fund manager with more resources, you would send somebody to the company, take it, move it back to the office very quickly, and you would have some time advantage versus smaller fund managers, for instance, in reviewing the data. Today, if you live in Manhattan or in Kazakhstan, if you work from the office or you're stuck at home because of COVID-19, you have the same exact access to Facebook quarterly earnings the exact moment they put it online. The internet has changed access to information dramatically. So, should you pick stocks? Obviously, my answer is no. You should use ETFs and focus on asset allocation, which is why tonight we're talking about this. So you should focus on asset allocation for 2 reasons. One is that it's the main driver of portfolio returns over time. And 2 is security selection actually doesn't work. So it's, especially if you're not a professional investor, you should not do it. Even professional investors actually cannot do that, okay? So what does it mean to focus on asset allocation? I mentioned it earlier, let me maybe repeat it. So assume that you have a range of asset classes. And what you see on the screen here, you have US large cap equities, sector, consumer staple equities or energy equities, emerging market equities, short-term US government bonds, long-term US government bonds, Singapore government bonds, gold, etc., etc. Asset allocation is deciding what numbers to put in the green bar at the top. So what percentage of your assets to put in US large cap equities, what percentage in gold, etc., etc., etc. Okay. So tonight we're only going to talk about asset allocation and about how to use ETF to create an asset allocation that makes sense for you and actually helps you achieve your long-term goals. So once you have decided what are the asset classes you want to get exposure to, how do you get exposure to these asset classes? And that's obviously when ETFs come into place. So what are ETFs? ETFs are exchange traded funds. ETFs, exchange traded funds. Why do we like it? Do we like them? Because they are very diversified. You buy into one ETF and you get access to a very large number of securities. So you're not doing security selection. They are diversified. They are very cost efficient. And on average, Stashaway's ETFs cost 0.2% per annum. If you go talk to your bank and you buy a unit trust, which is kind of the equivalent on the actively managed side, the bank will charge you probably an entry fee or 2.5%, and an annual management fee of 1.8, 1.9%. Whatever you don't pay in fees, it's returns for you. So it's very cost efficient. And 3 is liquid. It's easy to get in and out. It's easy to buy it and to sell it. Okay, so those are the 3 characteristics that we like about ETFs. Now, let me go through these characteristics with some examples. What you see on the chart here is 3 ETFs. And I'm not telling you that these are good or bad ETFs. I'm just showing them as examples of ETFs and therefore going through the 3 characteristics I mentioned. So I'm going to talk about SPY, which is a US equity large cap ETF. I'm going to talk about TLT, which is a long-term, longer dated, long maturities US government bonds ETF, and GLD, which is a gold ETF. So what are the asset classes that they track? SPY tracks the S&P 500, so US equities large cap. TLT, as I mentioned, tracks long-term, so US government bonds with more than 20 years maturities, and gold, obviously, GLD obviously tracks gold, and the index is gold spot price. So I've talked about diversification. If you buy into SPY, you are de facto buying 500 securities, the 500 largest companies traded in the United States. If you buy into TLT, you're buying into 35 different issuance of long-term US government bonds. Gold is a bit of a different case because obviously there is one gold, so it doesn't give you that diversification. I use gold as an example on purpose because it's the one-off example of where diversification obviously is not there. Second, I talked about cost efficiency. So how do you measure cost efficiency? I'm going to talk about this in more detail later, but this is high level. You can look at the expense ratio. SPY, for instance, costs 0.09%. TLT costs 0.15% per annum. GLD costs 0.4%. Those are obviously very low numbers. As I mentioned earlier, you can compare them to 1.7, 1.8, 1.9% for equities ETFs. Sorry, one thing, if you have questions, please put in the Q&A rather than the chat. I'm not going to be able to answer the question now. I'll just go straight, but at the end, I'll go through it. So 0.09%, 0.15%, or 0.4% are very low numbers when you compare them to the cost of investing in actively managed funds, usually unit trust, where for equities is 1.7, 1.8, 1.9%. For bonds, it usually is around 1.2%, and gold simply doesn't exist there. Why is gold GLD is a bit more expensive? Because the operations of managing gold investment is a bit more complex. Actually, GLD has real gold bars in their kind of in HSBC vault in London, and so the process of kind of moving those gold bars, keeping them secure, etc., is actually expensive. That's why it's called 0.4%. On top of it, you need to look at bid and ask spread. So whenever you buy or sell a security, there is the so-called bid and ask spread. I'm sure all of you have seen one of those kind of forex foreign exchange counter at the airport or on Orchard Road. And you always have 2 numbers, like, they buy at a certain price, they sell at another price. That's the bid and ask spread. So if you keep buying and selling, you actually lose money over time, right? Because you buy at a higher price and sell at a lower price because the FX counter actually needs to make money. So the bid and ask spread exists for any security or anything you buy and sell in the market. you want that to be as small as possible. Bid and ask spread for SPY is 0.00%, TLT is 0.01%, GLD is also 1 basis point, so very small. And lastly, we should look at liquidity. So how easy it is to buy and sell. SPY is a very, very large ETF. It's actually the largest in the world with $252 billion under management and trades $20 billion a day. So every day, there is $20 billion worth of SPY moving hands. TLT is also very large, 10 billion total size, close to $1 billion in daily volume. GLD, 32 billion asset size, close to $1 billion in daily volume. Those are very liquid ETFs. So those are very cost efficient, diversified, liquid ETFs. Now, ETFs have been incredibly successful over the last 15 years. As in everything that is successful, there is a lot of them out there now. And therefore, actually, you need to be a bit careful as you pick them. So I'm going to walk you through 4 criteria that you need to look for when you decide whether to invest in one ETF or another. Also going back to some of the topics that I just discussed. These are kind of the 4 basics. Stashaway, we have a longer list, but these are the 4 core ones that you want to look for sure. So first, we're going to talk about simplicity. We're going to talk about cost efficiency. We're going to talk about liquidity or ease of getting in and out. And then we're going to talk about tracking error, okay? So let's start with simplicity. Avoid smart beta ETFs. What are smart beta ETFs? They are ETFs that actually change allocation over time. So they allow for alternative weighting. Examples are something called merger arbitrage or USA momentum. They're very difficult to use for asset allocation because you don't know whether they will, how they will behave in different circumstances because you don't know what's going to be the actual asset allocation over time. Avoid leverage ETFs. What are leverage ETFs? Those are ETFs that are debt inside. So and usually they're called ×3, ×4, ×5. So for instance, if you buy the S&P 500 ×5 and the S&P goes up by 2%, that ETF is expected to go up by 10%. That is leverage. So it goes up 5 times more. If the S&P 500 goes down by 2%, the ETF should go down by 10%. So there is leverage. It goes up more, it goes down more. It increases significantly volatility through the use of debt inside the ETF. You don't want to get there. You don't need that. They also tend to liquidity in those type of ETFs tend to dry out quite quickly as soon as there is a lot of volatility in the market. Stay away from those. And lastly, stay away from inverse ETFs. What are inverse ETFs? Inverse ETFs are a way to short the market. So to bet in on the downtrend of the market. So you don't want to buy the S&P 500, you want to sell the S&P 500 without having it. You can short it, and there are ETFs that allow you to do that. Now, the problem with that is that ETFs are good shorting systems if you do it intraday. So if you short it now and then 2 hours later, you close the position. So they're good. They're used by traders to cover their positions intradays, but they're actually terrible on a multi-day performance. So don't do that unless you are a professional trader covering, trading on a daily basis, which I don't recommend anyway doing, and you're trying to simply hedge your bets throughout the day. So avoid smart beta, avoid leverage ETF, avoid inverse ETFs. Choose, in fact, plain vanilla, linear, index tracking, passive ETFs. So second, let's talk about cost. Now, cost is not just expense ratio. You need to look at total cost. You need to look at expense ratio. You need to look at bid and ask spread. I explained earlier what it is. You need to look at tracking error, and you need to look at taxes. So expense ratio is obvious what it is. It's the the fees that the fund manager charges to the ETF owners. Bid and ask spread, I mentioned earlier, is the difference between what is the price at which you can buy and the price at which you can sell, which is an implicit cost when you buy and sell. Tracking error is the delta between the performance of the ETF and the performance of the index it's supposed to track. You want an ETF that is as close as possible to the actual performance, because any underperformer is de facto a cost to you. And lastly, you want to look at taxes. Taxes are obviously very important. Look at total cost. One question we often receive is, why do we trade in the United States, even if the United States is actually not the most efficient from a tax perspective? And the answer to that is that what it loses on the taxes side, it more than gains from an expense ratio, bid and ask spread, and tracking error perspective, because it's a much bigger, much more liquid market for most asset classes, not for all. for most asset classes, it's actually a better place to trade ETFs than London, for instance, where taxes are lower. So third, we want to talk about liquidity. There are two reasons why it's very important to choose highly liquid ETFs. One is that because when you want to sell, you want to have somebody on the other side of the table that buys from you, right? You don't want to be in a situation where you want to sell and nobody buys. So you want liquid ETFs. Second, because as I mentioned earlier, bid and ask spread is a cost to you, and bid and ask spread are actually caused by liquidity. So if you have a low liquidity, the bid and ask spread will be wider, and that's a cost for you. Okay, so these are two reasons why liquidity is so important. And to give you an example, I showed you TLT earlier that actually trades $1 billion a day and has a bid and ask spread of 0.01%. Look at DTYL, much smaller. Actually, the average daily volume is not even public; it's not meaningful, and the average spread is 1.9%. So that's a very large implicit cost that you want to avoid. And I don't want to talk badly about DTYL. I'm just saying, do your research. Make sure you actually check all of these numbers. Lastly, I want to talk about tracking error. So tracking error, as I mentioned, is the delta between the performance of the index that the ETF is supposed to track and the performance of the ETF itself. So for instance, SPY is an ETF that tracks the S&P 500, and it has a average tracking error of 0.25% over the last 10 years. That's very tiny. The other ETFs that you see on this chart, IUSA, CSP1, etc., they're all S&P 500 ETFs, mostly traded out of London. And as you can see, the tracking error is much larger. It's more than 2%, 2.5%. That's an implicit cost to you, in particular because tracking error tends to be asymmetric. So tracking error, in theory, could be overperformance or underperformance. Usually, it's mostly underperformance. And that's why you want to actually account for tracking error when you look at total cost of an ETF. Again, two reasons for the importance of tracking error. One is that if the tracking error is very high, it makes it very difficult to predict how a certain ETF is going to behave in a certain economic environment. And therefore, it's difficult to use it for optimization of portfolios. And secondly, as I mentioned, high tracking error is an implicit cost for you, as I mentioned, particularly if it's asymmetric. Okay? So before I move on, let's recap. So ETFs are a great instrument to get exposure to asset classes because they're diversified, because they're very cost efficient, because they're liquid. However, you want to make sure that you actually select the ETFs very carefully. And the four basic things you definitely need to look for are the simplicity of ETFs, avoid inverse ETFs, avoid leverage ETFs. You want to look for cost, and you want to look at total cost, so expense ratio, tracking error, taxes, as well as bid and ask spread. You want to look at liquidity, and you want to look at tracking error. Okay. Now, if you're still with me, and I've convinced you that the right thing to do is look at asset allocation, and I convince you that ETFs are a good tool to build your asset allocation by investing in asset classes through ETFs, then the natural next question is, okay, but now how do I build a portfolio now? Now, how do I decide, in fact, how to do the asset allocation, how to decide whether I want 10% or 20% in gold, for instance. And we're going to talk about how to build an efficient portfolio. If you have followed our investment basics seminar, you probably have heard about this, so I'm going to go a bit deeper than we went into that presentation. First of all, I'll make a step back. And this is a slide from the investment basics. So when you look at any investment, you need to think about returns and risk. Don't ever talk about returns without thinking about risk. It's very easy to increase returns if you just take more risks. If anybody ever talks to you about the amazing returns of a given investment without mentioning what is the risk of that investment, walk away. Okay, so what in the chart you see is a risk on the x-axis and expected returns on the y-axis. And you see four asset classes. You see short-term bonds, long-term bonds, real estate, and stocks. And as you can see, stocks are higher risk and have higher expected returns. And what you see is that the volatility or the variation in potential return is higher. You see the green normal distribution shows you what is the distribution of returns over time, and it shows you that stocks can return much higher than their average or much lower than the average, while short-term bonds will be more closer to their average. Over the long term, on average, these asset classes will tend to reverse to mean. So they will be giving you the returns that are on the black line, the average, over the long term. And this is very important when I say the long term, because in the short term, you know, the higher the risk, the more fluctuation. If you're asking yourself, where is Bitcoin on this chart? You need to kind of go out of the screen on the right side for kind of a quite a bit of time. Now, I'll keep the same two axes. So you can see in this slide, risk on the x-axis again, and expected return on the y-axis again. And every dot, every green dot that you see there is a security. In our case, it's an asset class. So, you know, if you kind of the ones, if you look at the ones that I'm pointing with the arrow now, those are going to be technology equities. They're going to be emerging market equities, you know, higher risk, higher return. If you look at where is my pointer right now on the bottom left side, these are going to be government bonds. And in the middle, you're going to have some corporate bonds, and then you're going to have some more consumer staple equities, for instance. So every dot is an asset class. And for every asset class, you have your risk and your expected return. Okay? Now, obviously, at any given risk that you want to take, you want to be as high as possible. So if you need to pick between this green dot and this green dot, you'll pick this one, right? Similar risk, much higher return. And if you want to take low risk and you need to pick between this guy and this guy, you're not going to pick this one. You're going to pick this one. Same risk, much higher return, right? In fact, the line, the white line with the yellow dots, it's called the efficient frontier. It's a mathematical maximum that return that you can get at any level of risk if you use these green dots to create the portfolios. You can, in theory, you know, push the line up by adding more securities, more asset classes. But given the universe that you're looking at right now, the universe of these green dots, the yellow dots are the best possible returns you can get at any level of risk. This is kind of a mathematical logic based on the modern portfolio theory that actually won a Nobel Prize around 50 years ago. So it's not so modern anymore. And this is the basic logic of portfolio construction for any institutional investors globally. So that's the way they mathematically look at having efficient portfolios over time. How you do this, how you create this line, how do you know that you are on the white line? If you want to do it yourself, what you need is for every green dot, you need the risk of your asset class, the expected returns, and the correlation among all of the green dots, all of the asset classes. So it's called a covariance matrix. It's a mathematical formula that gives you in practice an optimization based on risk, expected returns, and covariance. This is what kind of Stashaway does in the background for each of the portfolios, or one of the things that we do in the background. So if you have any question on this, just put them on the Q&A and I'll try to go through them as soon as we're done. If you're still with me and you believe that asset allocation is kind of the way to go, and you believe that ETFs are a good tool to actually get exposure to the different asset classes you want to have in your portfolio, and you understand what I've talked about right now of the importance of actually building portfolios using science and using math rather than just picking kind of by chance. If you're still kind of with me on all of these topics, then the next natural question is, okay, now I've built this amazing portfolio with 10% gold, 15% equities, et cetera, and this is my retirement portfolio, and I'm 30 years away. Should I ever change it over time? So my modern portfolio theory, optimized portfolio, is it always the same or should I change it? And different people will give you different answers to this question. I'll give you our answer, the Stashaway answer. Our point of view is that in the long term, it does make sense to adjust your portfolios over time. And we're not talking about trading in and out of the markets on a daily, weekly, monthly, or quarterly, or even annual basis. We're talking about long-term adjustment to your portfolios. And the reason is that returns change with the economic environment. So I'll show you some data. I'll show you 4 different economic environments using, in practice, at the bottom you see quadrants, right? So you can see where is my, so you can see now we're looking at the bottom left part of this quadrant, which is a recession. It's negative growth, low inflation. And then I'm going to look at growth and inflation in the other 3 quadrants. In that scenario, in a recession, the S&P 500, so US equities, on average, loses 10% per annum. In good times, when you have positive growth and low inflation, on average, US equities, S&P 500, makes 16% returns. When inflation starts going higher, you still have positive growth, but there starts to be compression on net earnings of companies, and therefore the equities tend to see lower returns. Still nice, very, very high single digits, around 8.8% on average in an inflationary growth scenario. And then if you actually go to a stagflation scenario, which is when inflation is so high that actually brings down growth, it becomes a recession with high inflation, then average returns tend to be around zero with a lot of volatility. So you don't see volatility on this chart. It's on average 2.7%, but there are some cases where returns were much higher, and some cases where returns much lower. Now, let me overlay another asset class. I use long-term US government bonds, 20+ years. And as you can see, it behaves very differently. It actually makes much better returns in a recession than it does in good times. So you want to take into consideration this information as you adjust your portfolio over time. Probably in a recession, you want to have a bit more of this and a bit less of this. And in good times, you want to have a bit more of this and a bit less of this, right? And I'm not talking about changing completely your portfolio. I'm talking about adjusting. I'm talking about taking into consideration all the information that are available in the market, okay? Using economic data, not rumors on the newspapers. So let me recap what we learned, and then I'm going to go into the Q&A. I saw a lot of Q&A coming in. What did we learn? Should you pick stocks? Hopefully, I've convinced you that the right answer is no. Why? A, it doesn't matter. More than 80% of your kind of difference in returns will actually come from asset allocation. And B, it's very, very, very difficult to get it right, to the point that only 1 in 5 professional asset managers actually beats the index. So just buy the index, buy the ETF that tracks the index. Where should you focus instead? On asset allocation. What instrument you want to use to buy into whatever asset allocation you have selected for you? ETFs. How can you pick ETFs? You want them simple, you want them cost efficient, you want them liquid. And should you adjust your portfolio over time? Yes. Look at the economy. The economy will give you a lot of hints on how to change your portfolio over time. If you are a client of Stashaway, you will know that around 3 weeks ago, we have reoptimized all of our clients' portfolios because the economic situation has obviously changed. And we have done kind of very well throughout the crisis, but because there is now a lot of uncertainty in the market, we have changed asset allocation, and things we've done is reduce US dollar exposure, which is obviously so far a very good call, given in the last 3 weeks since we've done it, US dollar depreciated versus Sing dollars by around 3%. But also we have increased allocation to gold and done a few other things. So changing your portfolio by looking at the economy is of incredible importance. Now, before I move to Q&A, let me spend a couple of minutes on Stashaway, literally a couple of minutes. I have a few slides, and then I'll go through as many Q&A questions as possible. So as I mentioned earlier, we are a digital wealth manager, and we help people like all of us invest their money, kind of take the money out of their saving accounts where they're giving you 0% or 1% returns, and actually put into work for your retirement, or to build your university fund for your kids, or to buy that villa in Bali that you've been dreaming of, or that Ferrari 10 years down the line. Whatever your dream might be, whatever your goal might be, or your goals might be, our job is to help you get there. We are a fund manager regulated by the Monetary Authority of Singapore. We have a CMS license for fund management. And because of that, and because it's the right thing to do, of course, we follow all of the MES rules, which include the fact that all of our customers' assets are in custodian structure and custodian banks. We work with Citi and HSBC. What does that mean in practice? Which is a question I always get, is if Stashaway were to go bankrupt, which we don't have plan to, and I don't see that happening. We're actually being very successful. But if Stashaway were to go bankrupt, your money will be absolutely safe because your money is with Citi and HSBC. And even if Citi and HSBC were to go bankrupt, your money will be safe because it's segregated. That's the concept of a custodian account. It's segregated from the balance sheet of the custodians, Citi and HSBC, as well as of the fund manager, Stashaway. I'm not going to go into the details, but I'm kind of very proud of what we've built so far. There is a decades of investment, technology, and management experience behind Stashaway. If you're interested in learning more, on our website, there is an About Us page that speaks about who sits on the board, who are the founders, what's behind us. And then maybe a couple of more transactional topics. Our fees are very low. We charge between 0.8% per annum for portfolios below $25,000, and then the number goes down as your portfolio grows with us, down to 0.2% above $1 million. Now, $1 million may seem very high for some of you, but in reality, if you're building a retirement plan with us, over time, you're going to get there. You know, you will need probably way more than $1 million to retire, and over time, you're going to get there. You know, if you invest $1,000 a month for 30 years, you get to $1 million. We have no minimum balance. So you can start with $10 if you want. Of course, you're not going to retire with that, but you can if you want. We have unlimited withdrawals, which means you can withdraw anytime you want. You just click withdraw on the app, and you're going to get the money around 3 days later. And there's no lockup, so you can invest today, withdraw tomorrow. Our recommendation is to be very systematic. Have a dollar cost averaging strategy. Every month, you have whatever you save, $500, $2,000, $10,000, $100,000 a month, whatever you save, put it on a standing instruction, create the right portfolios for yourself, and have the money go into that on a monthly basis. So very quickly, there are 3 portfolios that we offer. One is the core and higher risk portfolio, which is a set of 12 global growth-oriented portfolios, picking up out of 33 different asset classes. We have an income portfolio, which is an SGX traded portfolio of 6 asset classes, targeting a 3.75% dividend yield. And then we have Stashaway Simple. Stashaway Simple is a cash management portfolio. It's denominated in Singapore dollars. It currently returns 1.9% per annum. And it's an easy way to kind of start your relationship with Stashaway. You can also, a lot of our clients, what I've done is that they move a lot of their kind of safety net and extra cash from their saving accounts into Stashaway Simple. There is no minimum, no maximum. It's called Simple because there's no hoops you need to go around to get the 1.9%. And then you can actually set up a standing instruction from Stashaway Simple to your investment portfolio if you want a dollar cost average into the market. So this is the summary. Let me actually look at your questions. And I'll try to go to as many as possible. So I see there has been 105 questions so far, actually 106 questions so far. So thank you so much for asking so many. And most importantly, I see that my colleagues Amanda, Asher, Seeing, and Nathan have already answered 62. Thanks a lot, guys, because I would have, I guess, died if you didn't do that. So what is the largest amount a person has invested in Stashaway? We have a few people that have several $1 million with us. Yeah, I don't want to give specific, but quite a few people with several $1 million with us. Do you recommend buying ETFs on brokerage platforms, like buying a lump sum when there is a sale, or would Stashaway or other more available platform be ideal in the current climate? I obviously, so as I mentioned, I believe in dollar cost averaging. That's what I do myself. And I think Stashaway offers a unique way to be able to dollar cost average over time and get the right precise asset allocation over time because of the sophistication of the asset allocation framework on one side and the fact that we manage fractional shares. So if you invest $1,000 a month and you want only 10% of your portfolio to be in S&P 500, for instance, SPY and IVV traded around $300 per share. So if you only have $100 to invest every month on the S&P 500, you're only going to be able to buy every 3 months. While with Stashaway, because we're able to fractionalize ETFs, you're actually going to have exactly your 0.33 units of IVV both on a monthly basis. So short answer to your question, I believe that our offer is very difficult to beat in terms of sophistication of asset allocation platform, ability to actually get the precise asset allocation and stay true to a real dollar cost averaging strategy, very diversified. And 3, also from a price perspective, if you trade often, you will actually end up paying quite a bit of cost because usually brokerage firms have minimum cost per trade. And so if you trade often, you're actually going to pay quite a bit. I saw a question asking me if I said there is somebody with 700 million. No, I said several customers with several $1 million, not $700 million. No, we don't have anybody with $700 million. But if you have $700 million to spare, and I think we are a great platform for you. Now, jokes aside, I said several people, several customers with several $1 million plus. How to build a diverse portfolio of ETFs? I guess I answered that through the course of the presentation, so I'll skip that. I guess this was before I did that. Given increase in emerging markets debt, what are your views on the impact on long-term portfolio? I don't understand the question. Given the increase in emerging markets debt, what are your views on the impact of long-term portfolios? So I'm not sure I fully understand the question. I'll try to answer. In our global core portfolio, the 12 diversified portfolios, and the peak from 32 asset class, actually 33 now, so the slide is outdated. We have also emerging market debt, and that's used as it's actually not a defensive asset class. It's actually a growth-oriented asset class, and therefore it's an asset class that you want to consider as part of your universe. And in certain type of economic situation, you want to have some exposure to that. In other type of economic situation, you may want to stay out of it. Nidas asks, while I understand the risk associated with leverage ETFs, there are some leverage ETFs which have outperformed its non-leverage cousin over the long term. For instance, TQQ versus QQQ. Is it worthwhile making some exceptions? Look, leverage ETFs will always overperform in good times. As I mentioned earlier, the more risk you take, the more, the higher returns you're going to have. The problem is what happens when shit hits the fan, pardon my French. And that's why we're telling you, you don't need to take that level of risk. It's not, you can get 10%, like 8, 9, 10, 11, 12% per annum just with a diversified portfolio without any leverage on top of it. So, and you really need to try to get 14, 15% with the risk of maybe losing everything if something like, what happened in March happened. Check what happened to TQQQ in March. And I think you'll see that it's the risk is quite significant. So my answer is I wouldn't go to leverage ETFs. Kieran asks, hello, just wondering, could you earn significant amounts from stock selection through value investing? i.e., we have a range of prices of a stock, including a margin of error. Okay, so she explained what value investing is. Also, why would it be more risky to buy leverage ETFs? Okay, so two questions. So the first one, value investing is a way to do security selection. And as I mentioned earlier, only 1 in 20 professional fund managers actually have outperformed the S&P 500 in the last 20 years. Even Warren Buffett, who's kind of considered the father of value, the practitioner father of value investing, actually in the last 15 years has underperformed the S&P 500. And the reason is that it's very difficult to do security selection, and it's very difficult if you are Warren Buffett. And by the way, Warren Buffett has access to opportunities you don't have, just because people go to him in certain cases. So in 2008, he saved a couple of banks. Those banks will not call you; they will call Warren Buffett because you can put on the table $10 billion in 2 days. And so even with that advantage, you actually underperform the S&P 500 over time with the same amount of risk. And therefore, value investing again is a technique to pick stocks. Do I believe it's something you should be doing? I don't. I think proper diversification and proper asset allocation is where you want to spend your time and money. Second part of the same question is, why would it be more risky to buy leverage ETFs if the ETF tracks an index and as indexes have performed well in the long term? I hold this leverage index ETF for the long term, 20, 30 years. So the risk there is what happens is, so the risk there is what happens if there is high volatility in the markets. And there are two things that can happen. One is liquidity dries out, and there might be mispricing of the asset class over time. And in some cases, you can actually go to zero, and then returning from zero, it's quite complex. So in the long term, it's not obvious that leverage actually helps you. So leverage in general has this problem. Talk to anybody that in March had a leverage portfolio, maybe a leverage structure note with a bank. I think there is a couple of articles on Bloomberg saying how many people have actually lost everything because they had leverage structure notes. I was interviewing a person that works in a private bank, and he was telling me that one of his clients at a kind of a large private bank started, in March, early March, he had $8 million with them. End of March, it had $1.6 million with them because it lost the remaining $6.4 million because they had a very leveraged portfolio. And when the markets went down, lost everything. And going back from 1.6 to $8 million, it's very complex. You need to, you need to gain 500%. It just doesn't happen intraday, even if you have leverage. So my strong recommendation is stay away from leverage. What did the presenter say the negative thing about smart beta ETF was again? So the negative thing about the smart beta ETFs is that they're actually active, so they're not passively managed. So we go back to, it doesn't make sense to do security selection. Smart beta ETFs de facto make security selection. And if you want to use the asset class for portfolio construction, you want the green dot I showed you earlier to be as clear as possible. So you want to know what is the risk and what is the expected return. A smart beta ETF, because it changes allocation over time, you don't really know where it's going to be in the chart. And therefore, it makes it very difficult for you to use a systematic and mathematical approach to actually build a portfolio. Does Stashaway employ and include professional traders in its decision on ETF selection and its reoptimization effort? I mean, one of my two co-founders, our chief investment officer, Freddie Lim. You probably have heard him speaking if you have followed one of our seminar on asset allocation or on market outlook. And I encourage you to follow one of his seminars if you haven't done so. He and his team are in charge of continuing to develop our asset allocation strategy, including ETF selection. The reoptimization is done systematically. So the idea is that Freddie's job is not to make investment decisions or asset allocation decisions. That's done by a logic. Freddie's job is to continue to improve the logic, to continue to test the logic. Human beings tend to be terrible investors because we are emotional. And when the markets go down like they did in March, most human beings will just sell everything. And if you sold everything in kind of on the 22nd of March, you're probably very unhappy with yourself. While following rules that you write cold-blooded, and then you follow when the kind of things go very rocky, it's the right way to manage money for the long term. So that's what we try to do. Why do we believe that US ETFs will always go up in the long term? Like index in Japan peaked in 1989 and never returned to the same level. Thank you. I mean, nobody knows the future, so I'm not going to swear that USA ETF will always go up in the long term. But in the last 100 years, the stock markets have always gone up in the long term. You're right that Japan is an interesting example of a prolonged deflation with kind of economy being stagnant for a long time and the stock market also being stagnant. I think all central banks in the world have learned a lot of lessons from the Japanese example, and that's one of the reasons why they've intervened so forcefully and so quickly at the beginning of this crisis, right? So one of the reasons is that Japanese bank reacted very late during the 90s to the kind of the deflation that came after the crisis in 1989, and that's something that kind of people have learned. So can I promise that equities will go up? No, I can't. But in the last 100 years, they did. So there is, I would say, a very high likelihood that that will happen. Sorry, I've lost. What are the best software tools for technical analysis of ETFs return prices in the future? What we use is Bloomberg. So we use kind of the one tool we use for data is Bloomberg. Hi, can you elaborate on smart beta ETFs being poor choice for asset allocation? I mentioned earlier, so I'm not going to repeat myself. What is the current economic environment? So we're now in a technical recession. As you probably have read all over the place, I mean, as you probably witnessed yourself, COVID-19 has had a gigantic impact on businesses around the world across sectors, and all of us are working from home, as you can see. Now we used to do seminars in our office, and now we're doing webinars from my daughter's bedroom. And so that obviously had a significant impact on economies around the world. So we're now in a technical recession pretty much globally. The central banks and the governments around the world have reacted very forcefully to the economic situation. The central banks by printing money, so with the monetary stimulus, the government with fiscal stimulus, and that's why the stock markets have rebounded so quickly, and they're now kind of pricing a moderate recession, actually moderate to no recession, while we are actually still in a deep recession. The jury is still out to see whether the recession is going to be short-lived or long-lived. And also it will depend from how fast it will take to get a vaccine out, how fast it will take to get testing at scale and therefore traveling back up again, etc. So the jury is still out. But right now, to answer your question directly, we are in a recession. How can we check Stashaway's daily exchange rate? So I'm assuming this is talking about the forex between US dollar and Singapore dollars. So if you invest in Singapore dollars and you invest in our core portfolio, which are denominated in US dollars, we will do the forex from Singapore dollars to US dollars. That forex is done by our broker, and it's done at a spot rate with a 0.08% markup from the broker. We don't make money out of it. The broker makes 0.08% to de facto protect against the risk. This is 1/10 of what your bank will charge. So if you check kind of the biggest banks in Singapore, they will charge you somewhere between 0.7 and 1.2%. So it's 10 to 15 times more. How can you check what is the daily exchange rate? When you get the statement, you'll see exactly at what price we bought, so you can check there. On a daily basis on the app, you can actually see actually both in Singapore dollars and US dollars. So actually you see the exact forex by just doing if you just do the math. How do you pick which ETFs to invest in? So there are two phases. The first phase is deciding which asset classes to invest in. And then the second phase is for each asset class to pick the best ETF. So which asset class, you remember the chart I showed you with all the green dots? What you want to have is you want to have asset classes across the risk spectrum. So low risk, medium risk, high risk. And you want to have asset classes across the risk spectrum that give you the highest possible returns. You want the higher side of that chart. So that's the first step. And we have 33 asset classes for our core portfolios and 6 for our income portfolio. Once we do that, for each asset class, we pick the ETF that we think is best. And I mentioned 4 criteria earlier. These are the core. These are the kind of the core criteria we look for, which is simplicity, cost, liquidity, and tracking error. And then we have a few more. So we look at the fund manager, and we look at a few more characteristics. Why is the 36% risk portfolio restricted, not advised to certain investors on Stashaway? Is this because of lower risk return efficiency? Is this portfolio also suitable to just hold long term, or does it require a slightly adjusted strategy? So the high risk portfolios, so the core and high risk portfolio are 12, of which 9 are core and 3 are high risk. And the higher risk are 26, 30, and 36% Stashaway risk index. Those 3 portfolios are restricted to people that declare that they don't have financial experience or financial knowledge. If you believe that you should be access to that, get in touch with our client engagement team. They will actually direct you to a SGX exam. If you show us that you passed the exam, we'll actually give access to those portfolios. The reason why we don't give access to people that declare low financial literacy or experience is that those are riskier portfolios, and we want to make sure that people that invest in riskier portfolio understand that are taking risk. Peggy asks, is it a good time to buy now? Look, it's always a good time and never a good time. And the reality is that you don't know what's going to happen tomorrow. You need to maximize your time in the market. You shouldn't try to optimize for timing the market. And the way to do it is dollar cost averaging. So don't try to understand whether the market is high, low, right, left, or right, because that's impossible. Nobody knows. What you need to do is have a goal, set up a plan to get to the goal, and start the plan. If the plan requires you to invest $1,000 every month, you invest every month, whether the Straits Times first page says that the world is falling apart, or whether the Straits Times first page says that the world is in a kind of in Goldilocks. Just keep investing whatever amount you think you should invest, you can afford to invest, and it's enough for you to reach your goals on a monthly basis. Set up a standing instruction. Don't even look at it. Just do it continuously. If you did it over the course of the last 6 months, you've done tremendously well, because you would have invested as the markets went down, and then as the market went up again. So you kind of lowered your entry point as the markets went down, and now you'll be in very good shape. So short answer to your question is, it's always a good time to start. Try to dollar cost average. Don't invest everything you have at once, but try to kind of have a plan that gets you into the market over time. A good way to do it is, if you have a lump sum available, put it in Stashaway Simple, and then have a kind of dollar cost averaging strategy from Stashaway Simple to the portfolios you might have built. Just as a clarification, by the way, we don't make any money out of Stashaway Simple, so the 0.2 to 0.8% fees only apply to core and high-risk portfolio and the income portfolio. For Stashaway Simple, we receive a 0.125% rebate from the fund manager, and we actually give this rebate back to the customer. So we don't make any money out of Stashaway Simple in order to be able to give such a high return on cash. CCW asks, Stashaway is allocated assets based on all weather now. With the Fed announcing recovery may be slow, will Stashaway change to recessionary, and what is the cue that Stashaway will do so? So we keep monitoring the data, and we keep looking at the delta between what the leading economic indicators are saying and what the market is expecting. As of today, we think that the all-weather portfolio that we went into a month ago is the right way to, is the right balanced way to do right exposure, and the reason is that it does provide for more protection than a growth-oriented portfolio, but at the same time, it does also give exposure to some growth-oriented asset classes. We will continue to look at data. The Q is mostly on what will happen in the economy, whether the economy will start to pick up again or not quite quickly enough, and whether the pricing of the market and the economy kind of start to converge or keeps widening. Somebody asked, Smartly is gone just after a few years. How safe is Stashaway? So Smartly was one of the other two players that launched around the same time as we did 3 years ago, and they closed business around maybe 2 months ago, 3 months ago. You can't compare Smartly with Stashaway. Smartly had $500,000 Singapore dollars in paid-up capital. We have 27 million Singapore dollars in paid-up capital. They have a team of 5 people. We have a team of 80 people in 3 offices. We are backed by 8 Roads, which is the venture capital arm of Fidelity. So we're backed by Fidelity, one of the 5 largest asset managers in the world. I think you can't really compare. And so to the question, how safe is Stashaway? Very. And as I mentioned earlier, even if Stashaway were to go bankrupt, which again, not in the plans, but even if Stashaway were to go bankrupt, your money will be completely safe because it sits in custodian accounts. When we adjust the portfolio based on the economy, the changes already occurred in the market. Are we assuming that the economy market will be trending in a particular direction? So that's not true. Typically, the economy leads the markets, at least on the way down. On the way up, the markets tend to lead the economy. And therefore, if you actually follow the economy, you tend to be ahead of the economy. Usually when the markets go down before the economy, and they tend to do it in a correction style, which is what happened right now, for instance. So it went up, went down, and then went up much again. Bear markets tend to form on kind of a recessionary, after recessions kick in. And that's why the economy historically has been a very good tool to actually predict what happens in the market. It would have worked well in 2008, would have worked well in 2001, and it would have worked well in some of the bear markets before that. Given that we are advocating for ETFs and not choosing individual assets, is there therefore no role of buying company equities off the stock market anymore? That's our point of view. Our point of view, and it's not ours, right? It's our point of view, and many people, and most importantly, the data point of view. The money is in the asset allocation, and that's where you want to focus. Nina asks, if a Stashaway risk index of 22 means one cannot lose more than 22% in a year, does that mean there is a possibility of losing 20% in successive years, and that will be considered as being within the guidelines of SRI? So the 22% is not in a year, is at any given time, peak to bottom. So in a crisis like the one we just did. So there is in practice, so a Stashaway risk index of 22% means that there is a 1% chance to at any point in time to lose more than 22% on that portfolio. And a 1% event is, you could argue, is something that happens once every 100 years. I think what happened in March is probably a 99.9% event, and still our Stashaway risk index targets are actually hold well. And as of today, all of our portfolios are actually positive for the year to date. And if you look at 1 year, so 1st of June 2019 to 29th of May 2020, our lowest risk portfolio has done 7% return, and our high risk portfolio have done 16 and 17% return. So this includes the kind of the deep correction of COVID-19. Believe that many investors, including myself, will be willing to increase our portfolio if we have confidence that Stashaway will still be around in 2030 and beyond. I guess there's no question here, rather a consideration. And yes, I mean, we are building an institution, and you can just, I don't know if you saw the news, we announced last week that we have appointed a new director to the board, and it's an independent director that Wee Hoon Sin. She's a former CEO of Morgan Stanley Private Banking here in Singapore. The fact that we even think about appointing an independent director, and the fact that a person like Wee Hoon accepts to be appointed in the board, should give you a sense of the type of institution we're trying to build. You can find her profile, and you can find, in general, the board on our About Us page. And there was a press release and there was a Business Time article last week on this topic. There's a question on a few specific ETFs. I don't want to talk about specific ETFs. Is there a prescribed asset allocation split up across stocks, bonds, and gold? In gold, no. It depends from the risk you need to take. So if you have a very long-term goal, and you are retiring in 30 years, and you have personally, you can live with volatility, you can live with ups and downs, then you want to take quite a bit of risk, and therefore you're going to have a portfolio with more stocks than bonds. If on the other side, you're planning for a short-term goal, you have only 3, 4, 5 years, and or you are maybe a bit more risk adverse, then you're going to have more bonds than stocks. So it depends from what risk you want to take. Now, if you don't know, the Stashaway app actually helps you do that. There is something called goal-based investing that asks you a few questions on what are you investing for, and helps you recommend a portfolio for you. And the portfolio takes into consideration, the recommendation takes into consideration your personal preferences, which you would have answered during the onboarding process, as well as your timeline, which are the two things you want to take into consideration. If you haven't followed our investment basic course, we talk about this in a bit more detail during that course. What are the differences between an ETF and a mutual fund? So a mutual fund or a unit trust, as well as an ETF, are funds. So from a structure perspective, very similar. The differences are, from a structure perspective, the ETFs are traded on a stock exchange, and the mutual funds or unit trusts are sold over the counter at a bank. So you go to a bank, you buy them, sell them. That's a structural issue. Now, in general, ETFs tend to be passive in nature, so they follow an index, they track an index, while mutual funds usually are actively managed. I said usually because there are also smart beta ETFs that are actively managed, and there are some index funds which are also passive. There are unit trusts that are passively managed, but in Singapore, index funds are de facto non-existent. So in Singapore, the simplification of saying ETFs are passive, mutual funds or unit trusts are active is quite accurate. ETFs, therefore, because of their linear structure, ETFs are significantly more cost-effective, and they simply track an index, while mutual funds are significantly more expensive because they cover the cost of security selection. And as I mentioned, only 1 in 20 mutual funds over the last 20 years on the US markets have actually beaten the kind of a relevant ETF that track the index. Somebody's asking for our AUM. We don't disclose it. We will one day, we don't yet. Are there any other precious metal ETFs other than GLD that Stashaway likes? No, we don't. And the reason is that in general for commodities, there are some problems on how you actually get exposure. And in many cases, there are it's usually done through derivatives, and it creates a contango problem where actually it doesn't, so the tracking error becomes very relevant, especially when prices goes down. And gold is one of the few, or if not only actually, precious metal that actually have real asset-backed ETFs that also don't have that problem. Alex asks, I'm wondering how you're able to provide Stashaway Simple at no cost. We are able to do that because in reality, 95% of clients that invest in Stashaway Simple also invest in other portfolios. That's as simple as that. And we think that Stashaway Simple is part of the offering of kind of helping our clients, part of our clients' general money management is cash is a very important part of it. So we want to offer a product that is kind of a top world class and top of the market, which I think Stashaway Simple is today. I stopped at a certain point because I actually saw a question coming in, was asking where does Stashaway Simple invest in, and it's a portfolio of money market funds. It's a money market fund and an enhanced liquidity fund. You can see the details on our app. Please don't ask the questions on the through the chat. Ask them in the Q&A because otherwise I'm not able to go through the list in order, which I think is fairer. So in the meantime, we have received 219 questions, 220 now. I've answered, I think, probably 30. My colleagues have answered a staggering 143. I don't know how you guys do it. I'm going to go ahead for a little bit more. Let me check. Let me do a time check, and then I'll stop at a certain point. So I apologize in advance if I don't get all of the questions. I've now answered all questions that came before 7:50, so I feel quite good with myself. But let me go a little bit more. Dhruv asks, does Stashaway plan to allow clients in the future to also have a say in their asset allocation, geography, industry within a certain type of risk profile? We don't know yet. I don't rule it out, but for now we don't. The reason why we actually build the asset allocation ourselves is that we believe in scientific approach to asset allocation. If you start playing out with it, you're actually going to move out of the efficient frontier. So you want us to actually help you get on the efficient frontier. And so far we've done quite a good job. If you look at our returns over the last 3 years, it's quite outstanding. So I think you may want to rely on our asset allocation strategy. ET is asking, have you got backtested data on your 3 portfolios? I would like to understand how the portfolio helps deliver returns. Yes, you can find it on our website. There is 20 years backtesting data on, not on the 3 portfolio, there is actually the 12 portfolio, on the core and high risk portfolios. Should one invest only in Stashaway? Do you see any advantage in investing in traditional unit trust or ILPs? No, I think I don't see any advantage in unit trust and ILPs. And yes, I personally invest 100% of my financial assets in Stashaway. The only exceptions are I have a couple of angel investments, which we don't treat as Stashaway, and it's a completely different asset class, which is investing in startup companies, and that's it. Everything else is financial assets. I have a small apartment, but other than that, I have all of my money is with Stashaway. So I believe that you don't need to invest anywhere else. Unit trust actually do the same thing with ETFs, but they're simply less efficient in doing that. And ILPs are terrible products with very, very high fees. What you want to do is buy term insurance and invest the rest, not buy ILPs. ILPs are kind of a term insurance and an investment product at the same time and end up being very inefficient and incredibly expensive. The only one laughing when you buy an ILP product is the person that sells it to you, because the commissions are incredibly high. That's why so many people sell ILPs. The commission from distribution are incredibly high. If I have multiple portfolios, would it be advisable to hold on to all of them long term, or buy sell according to the market? If so, would Stashaway be able to advise what portfolio to let go or buy? No. So you should have portfolios that are targeting a certain goal of yours, and over the period of time until you reach the goal, you shouldn't sell them. So, for instance, in my case, I have a retirement portfolio. I have 3 kids, so I have 3 university funds. Those are kind of all fairly long term, because my oldest son is 6 years old, so I have a lot of time for university still and for my retirement as well. And so those have quite a bit of risk in it. And then I have a kind of I call it quasi cash. It's our lowest risk portfolio. And then I have some extra money in our higher risk portfolio. And the idea is that I'm gonna I keep this portfolio long term, going through the ups and downs, keep investing on a monthly basis, dollar cost averaging. And that's what gives you kind of significant returns over How should a beginner invest in ETFs in Singapore? Is finding a broker necessary? Yes. If you want to invest by yourself in ETFs, you need to either use Stashaway or open a brokerage account. If you're a beginner, I would recommend if you do when you do the selection, make sure you actually, if you do it yourself, make sure you actually look at all the details. When Stashaway adopts new ETFs into its investable universe, are the new ETFs automatically invested into by all the portfolio? No. Right now, for instance, we have 33 different asset classes in the Core and Harris portfolios, but every portfolio only have between 7 and 12. So the universe is kind of the green dots I showed you earlier, but then in each portfolio, there are between 7 and 12, and then those 7 and 12 change over time, as I mentioned, depending on where the economy is going. I'll try to answer 5 more questions, and then I'll stop. I hope you will pardon me for that. By spreading out large investments across several months, investing through dollar cost averaging, is there a difference investing 5,000 into 2 different portfolios or investing the whole 10,000 into a single portfolio? No, there is no difference. Our portfolios are already very diversified. The reason to have multiple portfolios is if you have different goals. So you might have a goal that mature in 5 years. You want to buy a house in 5 years, and you want to have a 30 years goal. And in the 30 years goal, you want to take more risk, which makes sense. So in that case, that's why you might want to have multiple portfolios. But if you are only you don't have a specific goals, you're simply kind of growing your wealth, you have a long-term goal for that, you can have one portfolio. Every portfolio is diversified now. With the current market volatility, is it better to dollar cost average over a shorter time span, say split the funds into twice a month rather than once a month? Look, you can bring it to the extreme and invest on a daily basis, but the advantage is not gigantic. I would say, if you want to do it twice a month rather than once a month, it's probably you're, decreasing even further the risk. I think though once a month is enough. Is it better twice a month? Probably yes. I mean, it reduces even further your kind of time in the market risk. So yes, definitely. Why not? And by the way, as I mentioned earlier, there is a Stashaway simple feature to actually invest automatically into our investment portfolios. And that can also do every 2 weeks. So you can do bi-weekly. Why REITs as a class is only introduced in your 36% risk range and not in the lower risk levels? It's very difficult to talk about a single asset class in a portfolio. Because as I mentioned earlier, one of the 3 main factors that drive portfolio construction is covariance or correlation among asset classes. So the presence of a particular asset class may be dependent by the presence of other asset classes and how those asset classes interact with each other, how correlated they are over a specific type of economic environment. So it's difficult to answer your question. Now, in general, REITs tend to have quite high volatility, and especially now, given the current situation, they tend to have quite a high embedded risk. Especially the specifics of COVID-19 actually make REITs kind of a bit higher risk than they usually are. Any promotional code if you decided to invest with Stashaway? No, I'm not going to share any code tonight. What you can do is invest with Stashaway and then introduce a friend of yours to the platform, and both of you will be able to invest up to $10,000 for free for 6 months. What is Stashaway's strategy in the long term for charging minimal, very low fees to their clients? So we use technology extensively. And that's how we are able to charge low fee. Because through the use of technology, we reduce significantly the cost in operation. So for instance, we don't have humans doing kind of placing trades in the market, which is what every bank does. So we have an integration that's, and by the way, it's better done by a system than by a person. There's a fat finger problem when somebody just typing, buy 100 units of this ETF. While if there is an API connection, and that's, that problem goes away. So we use extensively technology, and we are building a lot of scale. And, through the use of technology, we reduce our total cost, and through scale, we're able to pay for it. So that's what we'll be doing. How frequent Stashaway will update the current value? For example, I saw on screen $400, and when I sold it, I will get back the $400, and there is a lag on the profit every day. So every day we update current value of the asset classes by looking at the closing price of the previous day. Last question I'm going to answer today is from SY, because I've answered all the questions that came before 8 p.m. What percentage of total portfolio should ETFs comprise? ETFs can be 100% of your portfolio. As I mentioned in my case, out of kind of my cash, which is with Stashaway Simple, which are non-ETFs. So actually, Stashaway Simple, the two money market funds are actually unit trusts. But other than that, I have all ETFs. You know, ETFs are they're not an asset class, so you don't need to diversify out of ETFs. You need to diversify what's inside ETFs. So you want equity ETFs, bonds ETFs, gold ETFs, etc. But ETFs is simply an instrument, is a box, and you don't need to diversify the type of boxes. What you need to diversify is what's inside the box. Thank you so much for staying with me for so long and asking so many questions. There is now, it looks like I'm slower than you at answering than you guys are at putting the question. There is now 240 questions asked. My colleagues have answered 170. I believe I've answered probably 35 or 40. So hopefully we've done a decent job. We've answered more than 200 questions. Hopefully we've answered yours. If you have a question that we didn't get to, feel free to reach out to our client engagement team at support@stashaway.sg. I believe Amanda has actually shared on the chat earlier all of the contact details. Amanda, you may want to share it again so that everybody has it fresh there. Feel free to reach out there with any question you might have, and Amanda and her team will definitely make sure to respond to your questions. Amanda, is there anything you want to add from your side? Otherwise, I'm going to close.
Yeah, I think that's all good. Thank you, Michele, for answering all of that questions tonight.
Perfect. Thank you very much. Thank you, Amanda. And thanks again, Asher, Singh, and Nathan. I see you're still typing there. Thanks a lot. And thank you all for participating.